Well, where on earth do you begin this week? It's been quite a rollercoaster ride for financial markets over the last fortnight or so, and that might even be an understatement. Last week, of course, President Trump pulling a temporary U-turn on the idea of reciprocal tariffs, but nevertheless ramping up tensions with China, with the tariffs on either side there, amounting to an effective trade embargo between the world's two largest economies. The equity market loved the 90-day tariff pause, with the S&P having its best week in 18 months, but ongoing policy volatility and incoherence saw dollar and treasury selling in pretty relentless fashion as capital rushed for the exit doors out of the United States. Into the new trading week, another round of tariff headline watching surely awaits, though a busy data docket is in store as well as Q1 earnings season ramps up in this holiday shortened pre-Easter period. And we also got policy decisions from the Bank of Canada and the ECB in the mix as well. Plenty to discuss on the trade-off this week. So without further ado, let's roll the titles and get on with the show. So it has been quite a couple of weeks for financial markets while we've been away. Joining me as always to try and make sense of everything that is going on is my good friend Judith Chalmers from Forex Flow Live and Forex Analytics. And Ryan, considering that I've had my fingers and nose to the grindstone over the last 2 weeks while you've been sunning yourself on a beach in Spain, I'm going to put my feet up now and let you tell everyone what's going on.
Yeah, well, as far as I'm aware, you've been doing nothing but partying and going down the pub every afternoon and every night after NFP. So, yeah, you can cast your aspersions elsewhere, mate.
Oh, I wish that was the case. I wish that was the case. As I was saying to you just before we came on air, you either timed your holiday brilliantly or terribly, depending on which way you look at things.
Yeah, well, looking back at things, I mean, I've checked my phone now and again on holiday, in between getting daggers from the wife. But, when you're looking at it and euro dollar trading 109 1 minute and 114 the next, you think, no, I'm putting the phone in the locker and, enjoying the holiday, which is what I did.
Yeah, at that point, I think I'd have thrown my phone in the sea. But at least the euro rising up towards the 114 mark did see me win a free lunch. Anyway, we shouldn't hang around chatting because we've got far too much to talk about. So let's get into Topical Thunder. There really is only one place we can start this week, and that is, of course, with the issue of trade. And I feel like we're going to start with the issue of trade probably for the next 3.5 years until Mr. Trump leaves the Oval Office. Where have we been then over the last couple of weeks? Well, we've obviously had this to and fro over tariffs at a frankly breakneck pace. And if you watch this back any later than about 24 hours after we've recorded it, the situation is probably going to have changed again. So please do bear that in mind. Of course, going all the way back to the 2nd of April, which feels like about 3 decades ago, we had Liberation Day, where we had these huge reciprocal tariffs imposed on pretty much all of the US's trading partners. Now, I use those little inverted quotes there because they weren't reciprocal at all. It essentially involved a bit of suspect maths involving the trade surplus that countries run with the United States, which resulted in tariffs upwards of 40-odd% on Vietnam, 20-odd% on the European Union, and us here in the UK were supposed to be grateful that we only got slapped with a 10% levy. Thank you very much, Mr. Trump. In any case, 6 days later, as markets were throwing a tantrum, the S&P had fallen right onto the precipice of a bear market and treasuries were selling off violently across the curve. President Trump decided that actually he's going to pull a bit of a U-turn, not quite tearing up those reciprocal tariff plans, but putting a pause on them for 90 days and instead seeing the baseline 10% tariff on US imports remain in place during the next 3-month period, which I believe, if my maths is correct, takes us to the 8th of July. Now, that's all well and good and gave risk appetite a little bit of a shot in the arm, as we mentioned earlier on. But China is a completely different story at this moment in time. What we are seeing between the US and China is effectively a tit-for-tat trade war at this moment in time. The US put their tariffs up, China put their tariffs up, the US put their tariffs up, and so on and so forth. We now have a situation where the US is charging an import tax of 145% on goods coming from China, and China is charging a levy of 125% on goods coming from the United States. It's slightly ironic that a communist country picked this up before President Trump, but effectively those tariffs are so high that it means a market for goods on either side just does not exist anymore, apart from for those products with the widest of margins or which simply cannot be sourced anywhere else. So we do basically have a trade embargo or a blockade now between the world's largest and second largest economies. Now, markets have clearly got very, very excited over this U-turn and Trump caving in on his signature policies after just 5 or 6 days. But I think we need to bear in mind that this is hardly a sort of economic boom that we are now talking about. When we have this 10% blanket tariff and the 140 odd percent tariff on China, you're still looking at an average effective tariff rate north of 20%, which is easily its highest level in several decades and will clearly be a huge hit for the US consumer to deal with. The other issue that market participants don't quite seem to have managed to get their heads around just yet is, fine, we've got a 90-day pause on tariffs, but realistically, all we've done is just lock in an elevated degree of uncertainty for the next 3 months. You know, what deals will be done during that 90-day period? It typically takes months and if not years to negotiate a trade deal. What happens at the end of the 90 days? Is it extended? Do the tariffs go back on? Frankly, we have no idea, and I'm not even sure if people in the Trump administration have much idea at this moment in time. The net effect of that, of course, being that no business or consumer can really plan or invest in that sort of an environment. Now, a lot of participants have been saying, oh, well, what are the Fed going to do? We hear from Fed Chair Powell on Wednesday. He's making some remarks. I think the short answer is not a lot. FOMC policymakers will want to be sure that the upside inflation risks from tariffs are indeed temporary before delivering any further steps towards moving the Fed funds rate back towards neutral. So they are firmly on the sidelines for this moment in time, despite the hit that we are going to see to economic growth. Now, of course, all of this can be solved very, very easily by one man in the Oval Office just going back and unwinding and ripping up everything that he's done. But I don't know about you, Ryan. I think there's more chance of pigs flying than that happening, to be honest.
Well, you've certainly seen those pigs flying before regarding the ECB. I remember a couple of years ago. So never rule out the flying pigs. But yeah, I mean, it's the biggest take I had from coming back from holiday and seeing this and going through all the headlines is that it's just a huge amount of uncertainty. And if that's one thing the market doesn't like, it's uncertainty. It can deal with bad news. It can deal with a situation that is all out in the open that it can deal with. It can reprice and, you know, wait for a resolution. But when you've got this constant uncertainty, you're getting tariffs and then you're not getting tariffs, and then the tariffs are less, now they're more, now some products are reclassified as other tariffs, and you know, markets can't deal with that. And I'm going to talk about those sort of flows a little later, but yeah, it's no one knows what to do. No one knows what to do. Fed, central banks, everyone, no one just knows what to do with this. And as you say, that's going to be the same for businesses. But then, you know, there may come a point where business goes, well, we're here, we're doing business, we've just got to keep going, and they, you know, they can sort of block it out. So I think you've got to watch out for, if the market is getting really fearful about this, then it's probably, as always, going to go to the extreme and get overly fearful about things. And if it does that, then for me, I'm going to look at maybe taking the other side. But there's a long way to go for this yet, and you better be strapped in for it.
Yes, very much so. And I think, well, excuse me, I can't really remember what I did yesterday, but I believe we spoke before you went on holiday about how participants have been kind of expecting and hoping that Liberation Day would be a clearing event and just answer all our questions. I think it's very, very safe to say at this moment in time that it proved to be the complete polar opposite of that. Anyway, we'll get back to tariffs and trade probably in about 30 seconds time, but let's try and steer the subject onto something else in the meantime.
Yeah, well, we do have two central banks coming up, as you mentioned, the Bank of Canada and the ECB. Not that they're really important right now, but they're watching the political mess as much as we are, and two of them will at least be reacting to it this week. First up on Wednesday is the Bank of Canada, and they're expected to keep rates on hold at 2 3/4%, though expectations are a little bit final. There are some people who are still expecting them to maybe cut again. One of their main worries over US tariff policies was higher prices and thus increased inflation. And given the tariff story so far, that might already be starting to feed through. And so on top of that, cutting rates further can induce inflation as well. So that's an aspect that they will be looking at. On the other side, on the flip side, they will be watching for the impact of tariffs on US policy and their own economy. So they won't be closing the door to any sort of rate moves. And indeed, as Mackler noted at the last meeting, they're not ruling out unscheduled rate moves if something severe happens suddenly. So they are ready to go both ways if they need to. But I think the market is largely right with expectations of keeping on the pause. But what I'm looking for from this meeting in particular is what their opinion is going to be and how they're going to cope with this latest tariff mess. It's likely to be more uncertainty and kicking the can perhaps, but we're going to get some comments that are going to be directly impactful on those US policies. So that's going to be my main interest there. Second up is the ECB on Thursday, and this one might be a bit spicier. The market is expecting another 25 pip cut, which is a bit surprising given that we've heard from various ECB members indicating that it's a bit up in the air and that they might indeed pause. What the market is doing, though, it's looking at its continuing souring expectation in the economy and sentiment over in the Eurozone and raising their expectations for how far the ECB are going to cut. I've seen calls from, I think, Goldie's saying that they're now going to do another 25 pip cut and taking their rate down to a terminal rate of 1.5% from 1.75% by the end of this year. So a lot of the market is getting a bit more dovish over this. But as I say, these ECB members have maybe been coming around to the fact that they might need to pause. So the decision might be a closer run thing than what's expected. But as I say, at least we should get further clarity from Lagarde and Co. on the focus and where their focus lies regarding US policy. And I'm inclined, I think, to side with potentially seeing a pause at this meeting just to get over this further uncertainty. But that's not a high conviction call by any stretch. So I'm going to pass it back to you, mate. What do you think the ECB are going to do?
Well, clarity from Christine Lagarde. There's a sentence you don't hear too often without the word "not" in it somewhere. I think the ECB have to cut, to be completely honest with you. Yes, Europe is finally getting its act together on the fiscal front, but fundamentally, I mean, the tariffs that have been imposed, even though they've been halved to 10% now, you still got the auto tariffs that are going to hit Europe pretty hard. Eurozone inflation is finally moving in the right direction, including the stubborn services metric has started to roll over as well. And I think the only sort of governing council voice who has made their opposition to further cuts known is Robert Holtzman, who sees absolutely no reason for any cuts whatsoever. But then again, he is a very, very aggressive hawk, so that's not entirely surprising. I think what's more interesting is probably what the ECB do in June. Obviously, that's a hell of a long way away, and a lot can and will change by then. But that is when we get the latest economic forecasts out of the ECB as well. So it gives them a little bit more, or something slightly more concrete to base their argument in. As for the Bank of Canada, they won't be doing anything this week, I don't think. Frankly, they can't really do anything. Of course, Canada being in the middle of an election campaign does rather complicate issues for them, particularly when the bloke running to be Prime Minister used to run the central bank. It wouldn't be a great look to deliver a 25 basis point rate cut when one isn't really necessary. So I think they will try and sit on the sidelines as much as they possibly can.
Yeah, absolutely. As I say, the actual actions from the central banks aren't that important. It's what their thoughts are regarding US policy and how they see things moving forward. But I expect uncertainty to be the word of the week regarding those two central banks.
Yes, absolutely. If you take a shot of something every time you hear that, you'll be absolutely smashed about 5 minutes into the Bank of Canada press conference, I think. And you'll probably have just about recovered in time for Christine Lagarde, although that might make listening to her a little bit more pleasant, to be honest.
Yeah, well, I'll spend most of my time worrying about what she's wearing and whether De Guindos is going to speak. So, a few shots along the way might help me in that.
That's very true. Right, enough about our drinking habits. We need to talk about what's going on in the United States, because there's been plenty of attention on all of this tariff nonsense, but it's becoming pretty clear that all of this incoherence is actually starting to spook market participants quite considerably. And I think some of the market moves that we saw last week were really interesting, because it's a sign of potentially the US, well, really shooting itself in the foot, to be completely honest, and eroding its institutional credibility at quite a rate of knots at this moment in time, given the, as Ryan said, ever-changing nature of trade policy coming out of the Trump administration. Now, I think there's two market moves last week that really sum this up for me. The first is in the foreign exchange space, where the dollar traded lower against all of its peers last week. The dollar index down by about 3%, trading to three-year lows. Yes, I know the dollar index isn't perfect, but just go and look at any G10FX chart, even go and look at the Bloomberg dollar index, all of them falling off a cliff, or showing the dollar weakening significantly at the very least. At the same time as that, across the Treasury curve, we saw a pretty brutal sell-off. The 10-year Treasury yield rising 50 basis points on the week, in its worst week since 2001, while the 30-year Treasury yield rose by about 45 basis points in its biggest one-week rise since the 80s. Even Ryan wasn't trading back then. Remember Liz Truss? Do we remember that? Do we remember how the pound and gilt moved in the opposite direction? Do we remember how capital was desperate to rush to the exit doors out of the UK and find a safe haven somewhere else? Well, to be honest, that's kind of what we're seeing, but on steroids, given the speed of the move last week. Now, the issue here for me is that when these institutional and international investors and reserve allocators run away, it's not like they're going to run back anytime soon. Even if Trump were to pull a big U-turn on all of his policies, we've gone down this road once. The trust and the reliability and the credibility, if it's not gone already, it is going very, very quickly. And of course, this is a sort of exorbitant privilege, to coin the phrase, that the United States has enjoyed for decades. It is not a guarantee. It's not a God-given right that the United States will enjoy that forevermore. Now, to be very, very clear, at this moment in time, there is absolutely no alternative to the dollar as a reserve currency whatsoever. However, having said that, if these tariffs continue, if the nonsense out of the Oval Office continues in the same manner, there could potentially be, well, certainly less, less need for people to be holding dollars if trade with the United States decreases, and also, frankly, less desire to hold dollars, with the greenback being anything but a safe haven. And if we do see that develop, and I think this is something that, of course, will play out over months rather than the next couple of hours, then I think we could be looking at that situation regarding the US more broadly just starting to shift. And to be honest, that is quite a scary prospect.
Yeah, well, first and foremost, I was trading in the 80s, but it was Panini football stickers more than markets. But and
like that, a pit for those on the floor.
Yeah, exactly. Well, there was always a market for something in those cards, I can tell you. No, the 80s, I'd have been 8, 9 years old. So yeah, I was trading football stickers. But anyway, back to the topic in hand. I think you've nailed it on the head. The issue the US has got and Trump has got is if you shake investors' confidence and it flows out of your country, it does take a lot to come back. These guys, big investors, big funds, they're not day traders, okay? They don't flip in and out of markets like we do, normal trading. So if there is a fundamental shift out of a country, it's going to last for a pretty long while because there's a lot of money to move, and it's going to take a lot for that money to move back again. So I think, obviously, it looks as clear as day that Trump took one look at markets last week and thought, right, I need to reverse all this. But it's not done by any means, because we've still got this uncertainty. Like you said, 90 days, who knows what happens? Who knows what he's going to pull out the hat next regarding whatever tariffs? And that is going to be a problem for the US. And I think, obviously, US as reserve states currency, no, that's not going to change whatsoever. Can the US recover from this, I think, is the question, and how long is that going to take? As one of the Fed members has said, they're seeing economic weakness in the soft data, as we've been pointing out. I've been pointing out by some of the survey data, but not in the hard data yet. And I think if we get that hard data shift and we're getting negative data there, then you're going to see those flows picking up speed, and who knows where this ends up.
Yeah, absolutely. And of course, I think on that subject, the retail sales figures, March retail sales out Wednesday lunchtime, excuse me, that's going to be very, very important indeed, because as you rightly say, we have seen both consumer sentiment and consumer confidence having fallen very, very significantly indeed in recent months. The question now is, has that translated into people tightening their belts and actually spending less? And if that has indeed happened, well, we know the degree to which the US consumer powers the US economy. If the consumer stops spending, then it's very, very difficult for the economy as a whole to actually generate any growth whatsoever, particularly when you consider, and I appreciate this is getting slightly nerdy now, but Q1 GDP is probably going to be hit pretty significantly by this massive surge of imports that we saw into the United States. Not only all of the gold nonsense that everyone's been talking about, but just imports in general. I mean, you look at the exports data from China that we had this morning. I think exports were up, what, 12, 13% on an annual basis in March. That is purely people going, we know a tariff is going to go into place. We are going to get our orders in now and get goods into the country in Q1 before we have to pay those, well, at that point it was a 40% tariff. I mean, now it's, God knows what. And that is also going to act as a drag on GDP growth as well. So, I think it's going to be an interesting next kind of 4 or 5 weeks. We're in that window now where we start to get some of the first hard data points referencing this period over which uncertainty has risen massively. And I think this is kind of the make or break time of, everyone is worried about a recession. It's become a case of, okay, show me the recession. Well, give it 2 days and the data might start to actually point to that.
Yeah, exactly. And I think that's what we've got to be careful with the data. You mentioned China, on the flip side, they're probably going to produce some decent GDP numbers purely on that short-term effect of all their exports booming, which means later on down the line, that's probably going to fall off a cliff. And maybe the reverse for the US, where it shows negative GDP numbers or very low GDP numbers because they've been importing a lot. And that flips around once they chew through all those stockpiles. So it's going to make everything a bit messy, and we're going to have to know how to pick through it. But we'll save that for later shows.
Yes, absolutely. I'm sure there will be plenty to pick through. But if capital is leaving the United States, where's it going?
Yeah, and this is what I wanted to follow up on your topic, just to try to pinpoint where some of these flows out the US and the dollar will go. Now, none of this is an easy task for investors because they want yield as much as they want safety amid these turbulent times. Now, the euro has been the obvious beneficiary at the moment so far, and we need to understand why. For one thing, the euro is the second biggest currency traded in the world. Okay, so it is huge. So it does offer, I won't call it reserve status, but it does. You can sort of categorize it as that in terms of stability. Because let's be honest, euro dollar isn't ramping up higher, trading up towards 115 because the eurozone is booming. All it is just not as politically crackpot as the US is right now, which is saying something for given what we've seen in politics over there at the moment. But we can also see the safety aspect coming in because there's a bid in European bonds. So money's flown into European bonds where it's exiting out of US bonds. So that's the safety trade there as well. However, I think that moves into the euro won't be happening in a straight line. We'll get these volatile moments, but I think at some point there's going to be a point where we get to the safety trade level over in the euro over what the fundamental level is in the euro. And when we get into that, then the market's going to say, okay, you've had your move into safety, but the euro shouldn't be up this high based on the fundamentals and what the central bank are doing. Now, we're also getting into some decent technical territory, and I'm looking at the euro dollar chart here. Over the last 15 years of trading, there have pretty much been 5 levels that have never left my charts, and one of them is bang on at 115. We've already had a sort of half test up here around the 114.70s, so this is really a key level to watch over the next few sessions and days ahead. It really is a big decades-old level. Now, another asset that I want to look at that's also shown its hands, obviously gold. Now, Initially, it dropped back into the 2900s, and then it went on to rally to new all-time highs, which shows that episode was purely a safe haven trade. At first, the market didn't know what to do with the dollar, so we saw that gold coming off into the 2900s, then rallying back up again. Technically, it traded very well, dipping to the big break point at 2950s before then ripping on through the prior high 3155s up into the 32s. So this one is the one to watch for a continuation of the US risk-off mood. Now, one last aspect that I think is very important is that sometimes when you get this big uncertainty in markets, they don't know what to do. So they go swimming around trying to find yield, safety, and whatever. But if the mess becomes too big, sometimes markets just move into cash. They take their money off the table, put it on the sidelines, and say, when things calm down, then we'll get back into it. So that's something we also need to look forward to. So if investors don't like the US and see no real options to reappropriate their investments elsewhere, then you can get a complete move to the sidelines. And in such a situation, you'll see selling in all major assets. That's stocks, bonds, gold, whatever. So if you see that happening, you know that players are pulling their money out of the market altogether. So there's lots of things we need to watch for over the days and weeks ahead. And it's going to be interesting times.
Yeah, definitely. Certainly plenty of moving parts. I think your last point around effectively having no position is a position in itself is a very important one, particularly when markets are as choppy and as volatile as this. I did think some of the moves that we saw, again, when you were on the beach towards the start of last week were really interesting. When we saw this selling pressure coming in gold and also in the Treasury complex as well towards the start of last week, that to me just smacked of participants selling winners in order to raise cash to put up margin calls elsewhere. We had the S&P down 6% Friday, another 3 or 4% on the Monday. That was a case of margin calls are being made left, right, and centre. Participants need the cash. How do you raise the cash? Well, you sell what's liquid and you sell what is in the green in order to put up that cash elsewhere. So that's something else just worth bearing in mind if we do see any of those conditions start to make themselves known once more. But I think gold is probably the most interesting asset out there at the moment, which is very, very rare for me to say. But if you think about participants looking for a safe haven, looking for something that is not particularly exposed to the whims of the US government, but also, frankly, reduces the risk of, let's say you go and, okay, I'm going to take my money out of the US, put it in Europe. There's always that risk that the EU do something stupid and try and throw tariffs on the US. We know what they're like. Or, 27 leaders plus the Commission can't actually agree anything, and we just end up at the end of the 90 days with no progress whatsoever. And then you kind of go, actually, well, you can get away from the political nonsense whatsoever by just going and parking your money in bullion. And I think that's why we saw, gold was up 7% or something last week. We're at new all-time highs north of 3,200, and looks like the yellow metal could shine for some time to come. Yeah.
You had to go and spoil it with a pun, didn't you? Dear me. Move it on. Oh.
Well, there was a temporary trading halt imposed on my puns last week, but conditions have improved sufficiently that I can bring them back.
So I missed an embargo, a pun embargo, did I?
You did. It was 3 days long. It's the worst 3 days of my career.
And the best for everyone else.
Yeah, oh, absolutely. I have no doubt. Right, let's move on to our plays of the day. Okay, so I am looking at sorry, I've just been very distracted by a post from President Trump, who has said, and this is very, very prescient actually for what we're about to discuss, Brian. He has said the best definition of intelligence is the ability to predict the future. Well, let's see if we can predict the future with our plays of the day.
Can I have next week's lottery numbers then, please?
Yeah, that's very much the vibe going there. What is he on about? Anyway, while we try and work that one out, the dollar index, I went short at the 104 mark, just north of the 104 mark in our last episode a couple of weeks ago. And I've got to be honest, I did not expect us to come this far this fast. But the case behind that bearish dollar view is frankly still intact. The idea of US exceptionalism is over. The dollar is far from being a safe haven, as we have just discussed. The Fed are really unable to do anything at this moment in time, and it looks like this capital flight out of the United States seems set to continue for quite some time to come. Now, I'm going to be clear, I don't anticipate the market will continue to move quite this rapidly to the downside. And of course, when we have come this far, this fast, there is the risk that we do see a little bit of a dead cat bounce, perhaps up towards that 101, 101.50 region. But frankly, given the macro outlook has, well, really deteriorated in the United States since we last spoke, there's little else for me to do other than to retain and reiterate my bearish stance on the buck. Ryan, we are looking at dollar yen. Let's see if you can predict the future as well. Well, let's see if we can unmute yourself first. That would be the
yeah. I could. So you didn't predict that, did you? You didn't predict I'll be muted for that.
No intelligence here, mate. That's clear. We knew that anyway.
Yeah, I'm looking at the dollar also and dollar yen. Obviously, there's lots of focus on the dollar side of things, lots of focus on the yen side of things too, particularly in this risk-off environment. So what I'm doing, I'm only back from my holiday, so I'm not getting too deeply stuck into trading short-term charts. So I'm switching to the wider charts, the clearer pictures, and the bigger levels only. We've had a couple of tests of the 142 level, and that's been a level that, again, has seen a lot of action over the last few months. So it's been a quite significant support point. I'm eyeing that up for a possible long. I might look to stretch the trade a bit, maybe down to the old 61.8 fib down at the 140, 40, 50 area. But if we do get a break through those levels, 138 is the next big level that I'll be interested in. So just for now, I'm setting my net quite wide, shall we say, for looking for longs.
Which I think is very, very wise given the prevailing market conditions. In any case, that does bring us to the end of another show. Not sure how we've managed to get through that in as quick as half an hour, but we have somehow. Thank you very much, as always, to my good friend Ryan Littlestone from Forex Live and Forex Analytics for joining me. Thank you also to our producer Kyriakos for bringing things together as brilliantly as always. Hopefully you've enjoyed the show. If you have, drop a like on the video, leave a comment as well. Let us know how you're trading the markets and your thoughts on all of the various nonsense that is going on at this moment in time. And the three of us will be back with another episode this time next week. In the meantime, stay safe in those very volatile markets and have a very happy Easter as well. Thanks as always for watching. Goodbye for now.